Hello, this is Connie Belden, and in this video we are going to take a look at preparing the flexible budget and activity variances, and then we're going to take a look at the revenue and spending variances. Okay, assume the following planning budget was developed for you based on the quantity, that's what Q stands for, is quantity of 100 driving hours. You're given the revenues and expenses. So what I did is I just took this information and I copied it into the exact same numbers into the column that says planning budget, because that's our planning budget. Next, we're going to prepare the flexible budget part. It says prepare the flexible budget if actual activity was 110 actual driving hours instead of 100. And then we'll calculate the activity variances as favorable or unfavorable. Okay, remember Q represents quantity, and so for this flexible budget, we're using 110 as our quantity. So 300 is the revenue per hour times 110. So 300 times 110 is 33,000. Now for wages and salaries, we have a fixed and a variable component. So this is how we'll calculate it out. We will take 8,000 for the fixed component and add it to the variable component is $125 per hour, which for the flexible budget, we're using the actual hours of 110 hours. So when you're calculating this, you actually want to take 125 times 110 first to get the variable part, and then add on the 8,000, the fixed part. So total is $21,750. For supplies, it's $1 per driving hour, so $1 times 110 hours, 110. Okay, equipment rental, you'll take $32 times 110 and then add 1,800. That gives you $53.20. Insurance is a flat fixed amount at $3,000. Miscellaneous is $1 times 110, that gives you 110, plus 600 fixed gives you 710. Okay, I will now add my expenses together. For total expenses of $30,890, I will take my revenues of $33,000, subtract my total expenses of $30,890 for net operating income in my flexible budget of $2,110. Okay, now I am going to determine the activity variance, the difference between the budget minus the planning. Okay, so 33,000 minus 3,000 gives me a positive 3,000. We'll talk about favorable or unfavorable in a moment. 21,750 minus 20,500 gives me 1,250. 110 minus 100 gives me 10. 5320 minus 5,000 gives me 320. 3,000 minus 3,000, there's no variance there, just 0. 710 minus 700 is 10. And then 30,890 minus 29,300 is 1,590. And 2110 minus 700 is 1,410. Now, this particular example, they were all positive. We'll look at what happens when it's negative in a moment. Now we want to identify them as favorable or unfavorable. If it's revenues or net income, a positive number means it's favorable. You have more in revenues or more in net income. A negative number would be unfavorable. Okay, so I do have a positive 3,000. I have more in revenues, so therefore that's favorable. Net income is a positive, so it would be favorable as well. Now, expenses are the opposite. A positive is actually unfavorable because that means you spent more than you budgeted. A negative is actually favorable. Think of that as saving money. So all of our expenses here, except the one that is nothing, are positive. So these would all be unfavorable. including our total expenses. Okay, now we're going to take this same information and we're going to take a look at the next exercise doing a revenue and spending variance. Okay, so assume you were given the actual dollar amounts at the driving hours of 110. So these were your actual results. Those were given. What I want to do is compare it to my flexible budget that was made for 110 hours. So I'm going to go up here and basically I'm just going to copy the numbers from my flexible budget and bring them down to here. Okay, so no need to rework it. I just brought my flexible budget on down. Now, same thing, I'm going to go left to right. Okay, so 34,500 minus 33,000 is 1,500 positive. 22,000 minus 21,750 gives me a positive 250. Now 100 minus 110 actually gives me a negative $10. We'll talk about that in a moment. 5,000 minus 5,320 actually gives me a negative 320. This would be a zero variance. 720 minus 710 is a positive 10. That's a negative 70 and a positive 1570. Now I went ahead and noted them as positive or negative to help me out with a favorable or unfavorable. Okay, so let's start with revenues. A positive revenue or net income is favorable, so that's favorable. That's favorable. Now let's go to expenses. A positive is unfavorable, so that's unfavorable and unfavorable. A negative means you actually save money, so that is actually favorable. So these would be favorable. Now, note here, when you put them into Cengage, go ahead and type this in as a positive 10. The favorable represents it's actually a decrease. Type this in as a positive 320 and type this in as a positive 70. Again, the favorable represents that it was actually a decrease there. Thank you very much.